Watch this closely. Look at how many trades we caught using RSI. Over and over, the market gives low-risk entries, clean setups, and precise timing. No guessing, just following the signal and letting the trade play out. All right, first thing, let's add RSI. Go to TradingView, click on Indicators, search for RSI, and add it. Now you can see it right here below the chart. So, what is RSI? RSI stands for Relative Strength Index. It's a momentum indicator that shows how strong buyers and sellers are. It moves between 0 and 100, and the most important levels are 30 and 70. When RSI is above 70, the market is overbought, and when it's below 30, it's oversold. Now, at first, this looks very simple. You might think overbought means sell, oversold means buy, but this is where most people make mistakes. Just because RSI hits 30 or 70 doesn't mean price will reverse. Think of RSI like a speed meter. Just because a car is going fast doesn't mean it will stop immediately. It can keep going for some time. The market works the same way. You'll see RSI overbought and price keeps going up, or RSI oversold and price keeps dropping. So entering based only on RSI is risky. So the important thing to understand is this. RSI helps you analyze the market. It's not something you depend on 100%. You should always combine it with support, resistance, trend, or market structure. That's how you increase your probability and avoid bad trades. Now, here's where things get interesting. There is one concept traders use with RSI that can help you spot moves before they happen, and that concept is divergence. Before we jump into real charts, let's look at a simple example so you can understand this clearly. Don't worry if it looks a bit complicated at first. I will keep it simple. On the left side, we have bullish divergence. On the right side, bearish divergence. Each one shows two things, price on top and RSI at the bottom. Here's the idea. When price is going down, making lower lows, but RSI is going up, making higher lows, that's bullish divergence. It tells us that sellers are getting weaker and price can move up. On the other side, when price is going up, making higher highs, but RSI is going down, making lower highs, that's bearish divergence. It shows that buyers are getting weaker and the market can move down. One important thing, not all divergences are equal. You have strong, medium, and weak setups. The bigger the difference between price and RSI, the stronger the signal. At the bottom, we also have something called hidden divergence. This is more advanced, and it usually means the trend continues, not reverses. But for now, focus on the basic divergence. So the key idea is simple. When price and RSI move in opposite directions, something is changing in the market. All right, now that you understand this, let's go to the real chart and see how this looks. Now we're on the chart, and this is where everything starts to make sense. I'm not entering randomly. I wait for a clean setup. The first thing I'm looking for is divergence. We are here on the 4-hour time frame. Let's start taking some trades using RSI. Here we see a double bottom. On the RSI, we draw a line from lower to higher points. Looking at this setup, the RSI makes a lower high while the price makes a lower low. We confirm this trade with the double bottom pattern. Once confirmed, we enter the trade, target resistance, and place the stop loss just below entry. In the same area, we also see a bullish divergence, with the price makes a lower low, but the RSI makes a higher low. We enter from this point, target resistance, and keep the stop loss below entry. We can also draw trend lines to identify better targets. Moving on, here is another bullish divergence. The price makes a lower low, the RSI makes a higher low, and the price forms a double bottom. We enter here, place the stop loss below entry, and target resistance. In the same area, we also see a bearish divergence, where the price makes a higher high, forming a double top, and the RSI makes a lower high. We enter a short trade, target support, and place the stop loss above entry. Notice we don't rely only on RSI. We combine it with market structure like double tops, double bottoms, and trend lines. Finally, Here is one more bearish divergence. The price makes a higher high, and the RSI makes a lower high. We enter the short trade, place the stop loss above entry, and target the nearest support. So now you understand how RSI really works, not just the basics, but how to actually use it in real trading. Practice this, and you'll start seeing these setups everywhere. And once you see it on the chart, you'll never look at the market the same way again. If you found this helpful, make sure to like the video and subscribe, and I'll see you in the next one.